Hey traders, and welcome back to the Finance Meister YouTube channel. So many traders struggle to find a single clean setup on their charts. And the main reason is that they are simply trying to use too many different trading concepts all at once. It just clutters the mind and the screen. In this video, we are going to simplify everything and show you a powerful day trading strategy that packs the most important concepts into one very clear, easy to follow plan. So if you've been feeling overwhelmed by your charts lately, make sure to hit that like button to show your support, and definitely watch this video all the way to the end. Since this is a day trading strategy, it means we will be opening and closing all our positions within the same day, without holding anything overnight. To make this system work for you, you first need to understand the basic core principles of smart money concepts. These principles are the actual foundation of the system, and your success depends entirely on how well you spot and apply them on a live chart. Before we jump into the exact strategy, let's do a quick and easy recap of these core concepts, starting with supply and demand. Supply and demand zones are basically areas on your chart where big players enter the market, causing the price to shoot away aggressively from that specific level. These zones show us where massive buying or selling interest is still sitting, which gives us amazing trading opportunities. Normally, we mark the exact starting point of that aggressive move as our supply or demand zone. When the price eventually returns to that area, we expect some kind of reaction because, for whatever reason, traders were highly active there in the past. But here is the catch. Not every single supply or demand zone is worth your money. To find the highest quality zones, we look for three major clues: inefficiency, a break of structure, and the overall distance the price moved away from the zone. These three factors help us measure the true strength of a zone, so we can focus only on the best setups. Let's break down inefficiency first. This happens when the price moves away from an area so fast that it creates an imbalance between buyers and sellers. On your chart, this imbalance usually looks like a fair value gap between the candles. This gap tells us that the price moved too quickly and didn't spend enough time trading at those levels. Because the market loves balance, the price will very likely return to fill this gap in the future, making the zone that caused the gap a key area to watch. Next is the break of structure, or BOS. In a bullish market, this happens when the price breaks above the most recent high. It's a simple confirmation that buyers are still fully in control and the uptrend is likely to keep going. Then we have the push distance. This is simply how far the price managed to travel away from our zone before it started coming back. The further the price shoots away, the stronger and more violent the rejection was, which makes that starting zone much more reliable for us. By putting inefficiency, break of structure, and push distance together, you can easily filter out the weak zones and focus on the high probability trades. For example, if a recent upward move checked all these boxes, meaning it left a fair value gap, broke the previous high, and pushed a significant distance away, we have a very high quality demand zone. When the price finally retraces back down into this zone, there is a very high chance it will bounce and continue its move upward. But what happens if the price doesn't bounce and instead breaks and closes below this high-quality demand zone? Well, this leads us directly to our next big concept, which is the change of character, or CHoCH. Breaking below a strong demand zone like this tells us that the buyers failed to hold their ground and the sellers have officially taken over. It is a major warning that the uptrend is done and a reversal is starting. When the price breaks a major level like this, it means the market structure has shifted and momentum is now on the seller's side. However, you have to be careful because a change of character can sometimes be completely invalid. This usually happens in messy, imperfect trends where the price seems to break structure but then immediately continues in its original direction anyway. This completely confuses retail traders who think the trend is reversed and start taking the wrong trades. Let's look at how this trap works step by step. Imagine we have a swing low that led to a nice breakout. A drop below this level might look like a textbook change of character. But if you look over to the left side of your chart, you might see that this low aligns perfectly with a major liquidity area. Tons of retail traders put their buy orders here and place their stop losses right below this low. This creates a massive pool of money, or liquidity, sitting right there. The big players, or smart money, want to target these stop losses. They will intentionally push the price down just enough to sweep all those stop losses, grab that liquidity, and then instantly drive the price back up in the original bullish direction. The main lesson here is that when a major swing low sits inside a clear liquidity pool, a break below it is usually just a liquidity sweep, not a real trend reversal. In this case, we do not count it as a valid change of character. If the price sweeps the liquidity and then climbs back into the range, it actually gives us an amazing buying opportunity. The trend is still bullish, the sell-side liquidity has been cleared out, and the market's next target is the buy-side liquidity up top. As smart money traders, we want to enter right after those retail stop losses are swept, which is where the real, powerful move actually begins. Now that is just one part of the puzzle. Let's talk about another major thing that can make a change of character invalid: the mitigation of fair value gaps. Spotting these gaps should always be one of the very first things you do when you open a chart because they act like absolute magnets for the price. Most of the time, before continuing its main trend, the market will retrace just to fill these gaps. This is why fair value gaps are so important to watch, especially on intraday charts like the 4-hour, 1-hour, or even lower time frames. So let's connect this to our previous trap. If you look at the left side of your chart and see an unfilled, unmitigated fair value gap sitting just under a major swing low, the price will often dip below that low just to fill the gap and rebalance the market before shooting back up in the original direction. This downward move isn't a real trend reversal at all. The market is simply rebalancing itself. So always check the left side of your chart for unfilled gaps. This simple habit will help you tell the difference between a normal market rebalance and a genuine change in trend direction, saving you from a ton of fake signals. By the way, if you're finding this breakdown helpful and easy to understand, please take a quick second to smash that like button. It really helps support the channel and lets us keep creating these free guides for you. And if you're looking for a highly trusted prop firm with incredibly fast and reliable payouts, you definitely need to check out Funded Next. They are one of the absolute pioneers in the space, offering both futures accounts and CFDs all in one single place, which gives you massive flexibility. They have challenge accounts starting from $5,000 all the way up to $200,000, and they even offer instant funding options, meaning you can skip the challenge phase completely and start trading live right away. Plus, for our Finance Meister community, you can get an exclusive 7% discount and a 120% account reward. But this is only available through our special link. Make sure to check out the link in the description below. Now let's talk about market direction and figuring out who is actually in control. Finding the dominant direction is always your very first step on any chart. You want to see who is currently steering the ship, the buyers or the sellers. Trading in the same direction as the dominant force instantly boosts your chances of winning because you are riding the market's natural momentum. So how does this system actually work? It all comes down to mitigations. When the price taps into or mitigates a demand zone, demand takes control over supply. On the flip side, when the price mitigates a supply zone, supply takes control over demand. This sounds incredibly simple, but it is incredibly powerful. Imagine a market in an uptrend, making higher highs and higher lows. Every time the price breaks structure to the upside and leaves behind an imbalance, a new, strong demand zone is created. These zones stay unmitigated until the price eventually dips back down to touch them, giving us the perfect spot to join the trend. But if the price cleanly breaks below a valid demand zone, it creates a change of character. This tells us two major things. Supply has officially taken control over demand, and a brand new supply zone has been created. From there, the price will keep dropping, creating new supply zones along the way until it hits the next unmitigated demand zone. This is where a battle between supply and demand happens. Sometimes this battle leads to a sideways consolidation, where the price just bounces between the supply and demand zones. Once the price finally breaks out of that range, we know which side won, and we simply align our trades with that winning direction. This brings us to our next tool, order blocks. Think of order blocks as highly refined supply and demand zones where massive buying or selling pressure originally started. These areas are incredibly important because they mark the exact spots where major institutions and big bank players place their trades, causing the price to move aggressively. We identify the very first candle that created the fair value gap as our order block zone, because that is where the decision for the big move was made. When the price eventually returns to this candle, there is a very high chance of a reaction. However, the strength of that reaction depends entirely on whether there are still unfilled orders sitting inside that block. Keep in mind that order blocks are not magic formulas that work 100% of the time. They are simply high probability areas where the price is likely to react. Just like any other tool, you should always combine them with other concepts and confirmations to get the best results. To put all of this together, we use a technique called top-down analysis. This simply means looking at multiple time frames to get the full story of what the market is doing. By looking at the big picture on the higher timeframes first, and then zooming into the lower timeframes for the details, you can find incredibly high probability trades. We always start on higher timeframes like the daily or weekly charts to find the overall trend, major key levels, and general market sentiment. Once we know where the market is most likely heading, we zoom in to the 4-hour or 1-hour charts to spot our exact entry and exit levels using the tools we just talked about. The most important rule here is to never overcomplicate things. We are only going to use the exact concepts we've discussed in this video. Let's look at how this actually plays out on a real chart using the dollar-yen on the daily time frame. On this daily chart, the only thing we want to mark are the major supply and demand zones close to where the price is currently trading. At the very top, we mark our most recent high, and at the bottom, we mark our most recent low. These levels are key because if we zoom into the lower timeframes, we can see they've acted as major turning points for short-term trends. So when the price gets back to these areas, we can expect some action. Looking closer at the latest aggressive downward move, we can see it left a bearish fair value gap. We can mark the candle that caused this imbalance as our bearish order block, which is a great area to look for selling opportunities. Right now, the price is trading close to this daily level. But since the daily chart is too slow for our actual entry, we need to zoom down to the 4-hour and 1-hour charts to look for our confirmation and a potential short entry. Overall, the big picture is bearish, and the price still has plenty of room to drop before it hits the next major daily demand zone. That is all the information we need from the daily chart. We know the market is bearish, and we have our key levels marked. Now let's step down to the 4-hour chart. Once again, our goal here is very simple. Check the direction and mark the important levels. The 4-hour market is in a beautiful, clean downtrend, consistently making lower highs and breaking through lower lows. This gives us a very clear support level to mark on our chart. The story here is exactly the same as the daily chart. The mood is bearish, and we want to look for sell setups that align with this dominant downward trend. However, we still don't have a solid, specific reason to just jump into a sell trade right off the daily order block. So, let's zoom in one more step to the 1-hour chart to find our perfect entry. On the 1-hour chart, things get really interesting. Unlike our higher charts, the short-term direction here is actually bullish. The latest upward move left an imbalance, showing some strong temporary demand. We can mark the candle that caused this imbalance as our 1-hour order block, and we can even include the wick of the next candle to refine the zone. When the price taps into this 1-hour order block, we know a battle between supply and demand is going to happen. If the price breaks and closes below this block, it proves that supply has taken back control. If demand stays strong, the price might keep climbing and even break above our daily order block. Let's see what happens next. The price cleanly breaks and closes below our 1-hour order block, proving that the sellers have officially taken back control. This is our clear green light showing that the short-term upward move is over, and the price is ready to drop in line with the higher time frame bearish trend. So how do we actually enter the trade? We simply wait for the price to create a brand new bearish order block on the way down. We place our limit sell order right at the start of that new block, put our stop loss safely above it to give the trade some breathing room, and let the market do its thing. You can easily take partial profits at a 1-to-2 risk-to-reward ratio and target the major daily support levels further down for even bigger gains. At the end of the day, remember that patience is easily one of the most valuable skills you can ever build as a trader. Waiting for these high-quality setups isn't just a recommendation, it is a discipline that you absolutely must master. So many traders, especially when starting out, fall into the trap of overtrading because they feel like they always need to have an active trade running. But successful trading is always about quality, not quantity. I really hope this video brought some massive value to your trading today. If it did, please make sure to smash that like button to support the channel. And if you are new here, go ahead and hit that subscribe button so you never miss our upcoming strategy guides. Take care, manage your risk wisely, and I will see you in the very next video.